boys. Today I have a little theory for you. So, I'm just waiting for the camera to load. Okay, perfect. So, today we are going to talk about two cycles which you can go through when you're trading, and that is the good and bad cycle of risk management. So, for this example, we're just starting with the bad cycle of risk management. So, what does risk management mean? It means for example, a good risk management on a trade would be to risk 1% of your trading capital on the trade. There are so-called things, they are called position size calculators. And what these position size calculators tell you is how much you are going to take on the position. So how much lot you are going to get your position in. And this is crucial because if your position is too big, you will suffer from emotions. And what's the killer of a good trader? It's, of course, emotions. You can trade your strategy all you want and as good as you want. If you don't have the emotional control, then you are going to be, I cannot say that, you're going to be snuggled, yeah, by the big black market. And it's going to mess you up. So just we're just going into the bad cycle of risk management. So at the start, there is bad risk management. That's how it all starts, with bad risk management. So this is the starting point. You have too much lot on your position. What that means is you can either win big or you can lose extremely big. And more often, beginner traders lose bigger than they win because they don't know how to set their stop loss and take profit correctly. So most beginner traders are like pending at a zero point 0.5 risk to reward ratio, which is really bad. You would always look out for a 1 to 3, 1 to 2.5 at least, or 1 to 2. That's a good risk reward ratio, and that's going to mess you up if you lose too big. So if you win, wow, you get heightened emotions. It's all good. It's all perfect. But then you lose. And this brings us to the next stage. This is the losing trade. So let's just keep in mind we have bad risk management. We do a losing trade. What is going to happen? If you lose too much, the more you have in risk, the higher your emotions will get, and the more extreme your emotions will influence you. And that brings us to the next stage, which is bad emotions. So a big losing trade is most likely going to get you bad emotions like fear, greed, which is there to fear, greed, frustration, unsatisfaction. You are not going to be okay with this loss if you don't have your emotions in control, which is then going to cost you more loss, which is going to bring us to the last point. You're going to suffer more loss because on this stage right here, you are going to begin to revenge trade. You are going to be frustrated and you are going to want your money back from the markets. And that is ultimately going to lead you to more loss because you don't have the right entry. You're just gambling your money away. on entries that are not even that clear, only to make your money back. And then the cycle repeats. There is frustration at the end. You close your trading day. You have lost big sums of money, more than enough money, more that your account can handle, or more that your emotions can handle. You are frustrated and you begin the cycle again at the next day, because if you're frustrated, you are going to want that money back, which brings us to bad risk management. You are most likely going to open a position with even more lots just to get your money back. And then this is going to be, the circle is going to be going to get bigger and bigger and bigger until your money is gone. Right. So we have understood that. Let's move on to the next point, which is the good risk management cycle. Right. So you have good risk management in place. You calculate your position on this position on NDX 100, so NASDAQ. I knew that my position size should be 0.03 lot on the live account to trade that. It's not that big of a, with like an account with 4,830 on my live account. It's not that great of a win. It was like $60, but it's okay. I'm fine with $60. Really, I'm really fine. That's okay. Eventually my account will get bigger, and if my account will get bigger, my profits will get bigger, and that's just the thing. I will just let it keep going and trade. From time to time, the lot size and the profit and positions will grow eventually. Yeah, so I'm just fine about that. So you can see I risked 2% on that trade. I was so you are always once you always want to risk between 0.5 to maximum of 2%. If you 2%, if you know that the entry is going to be really good, really good, then you are going to risk 2% of your account, but you are not going above that. You're never going to get above 2%. One is the perfect ratio, in my opinion, 1 to 1.5 risk reward. If we just type in 1, the lot size would change, you can see. So let's just do this again. See, the lot size will change. And for an example of a bad risk to reward, or a bad risk percentage, sorry, this would be you risk like 20% of your account. This is going to be a lot size that is 10 times the size of the lot size we have seen earlier. So if you risk 2%, it's 0.02 or 0.03. If you risk 20, it's going to be 0.26. That's really high. That's really, really high. Okay, so let's continue. You have good risk management in place. Then, the same example, you are going to witness a losing trade, which is then going to happen. It could always happen that you get a losing trade. It's okay. But with good risk management, you don't get these heightened emotions because you are fine with losing that trade, because at the end of the day, it wasn't that much. It wasn't that much that you have lost, and it's okay. As long as you don't lose too much, your emotions stay fine. Then you have either you have good emotions, you are glad that you didn't lose that much, or you have neutral emotions. Sorry for the E, which I got inside there. I can't edit it out because Loom, so the recording software, is ruining my interface somehow. But let's just ignore this E. That's not going to be here. Ignore this E. That's not That's not pretty. Just ignore this E. So you have either good or neutral emotions, which is then going to lead you to controlled loss. What controlled loss is you are not going to think about revenge trading or getting that money back. It will be okay for you because if you have your emotions in place, you haven't lost too much. That's going to be fine. You're going to tell yourself that you are going to trade again next day or trade again in 2 hours when the next setup appears. But you are not going to search for bullshit setups that are not going to end up clearly or in your direction, or you have fear that they could reverse. Then you are never going to take the setup. If you have fear on entering, screw the setup. It was not that was not it. That was not it. That was not the setup you want to take. So then you would be led into controlled loss, and that means you are satisfied with your outcome. So you are either satisfied or you're neutral about that. You're okay with the outcome, and that will lead you again to good risk management because you don't have the urge to get the money back. You know that if you stay consistent and you keep your risk management in place, that you are going to eventually make that money back, yes, and you're not going to lose that much. So this is going to lead you to good emotions. This is going to lead you to bad emotions and blowing accounts and screwing up your life accounts, just draining your money. This is going to keep you consistent. So this one right here, you can draw it on a piece of paper. You can stick it to your fridge. It's okay. Just keep that in mind. If you follow this exact thing right here, your emotions will change eventually. Your emotions will change. It's not that hard to change your trading emotions. Everyone's making it out to be that super hard thing. It's just rules. It's just rules, and eventually the heart pounding and stuff, it just disappears over time. So it took me 3 years. It's just going to disappear over time. It's just like poof, and it's gone. Once you are going to trade more, lose more, that is totally going to happen. You're not safe from losses, and from every loss you take, you get a piece by piece. You get calmer, and you get more structural. You're going to eventually end up in a place like me, where it's just you take a trade, you sit, you wait, you turn off the charts, or you sometimes look at the trade, and then it just either it hits TP or it just hits stop loss. There's nothing more to that. That you can't influence the market if you stare at your screen like this. You can't influence the outcome. It's just either the trade was good and you're going to hit TP, or you just miscalculated and you're going to hit stop loss. Shit happens. That's okay, and that's not bad or something. That's okay. But if you want to change your emotional state in trading right now, just follow this structure. That's going to instantly give you less emotions while trading. All right, boys, that was it. I hope you enjoyed, and I hope I could help you out with the emotional part a bit. That's just some lessons I learned during my trading journey that helped me out. And I just wanted to give you that theory so you can calm yourself a bit down. We're all eventually going to make it, and we are all eventually going to be profitable and get the money we desire, get the life we desire, if we just stick to the plan. Because the market doesn't care. Market doesn't care about us or our money, so we have to protect our money at all costs. Yeah, that's just how it is. All right, boys. Dan, see you on the next one.